All right, let's dive in. Today, we're going to tackle something that honestly feels a little backward at first, selling options. It's a strategy a lot of people use to generate income, but the logic behind it can seem completely upside down. So let's unravel this thing.
I mean, think about it for a second. Why on earth would you sell something as a way to bet on its price going up? Usually we sell things we think are going to lose value, right? This is the central puzzle of selling options, and it's exactly what we're going to solve today.
So stick with me here. We're going to walk through this together, step by step. And I promise, in just a few minutes, you're going to see how this seemingly backward strategy actually makes a ton of sense once you get the mechanics down. Okay, so first up, let's talk about selling puts. This is the move you make when you're bullish on a stock. And that's just a fancy way of saying you think its price is either going to go up or, at the very least, stay stable for a while.
So what does selling a put actually mean? Well, you're essentially making a promise. You agree to buy a stock, usually 100 shares, at a predetermined price, which we call the strike price. But, and this is key, you only have to do that if the stock's market price drops below your strike price. For making that promise, you get paid cash right up front. That payment is called the premium.
And this is where the whole selling insurance analogy makes everything click, right? You're collecting a payment today, the premium, in exchange for taking on a potential risk in the future. That risk is having to buy the stock if it drops. If that bad thing never happens, you just keep the cash. No questions asked.
Let's put some numbers to this to make it super clear. Let's say you like stock ABC, and you're pretty confident it's going to stay above $95. So you sell a put option with a $95 strike price. The moment you do that, someone pays you a $3 premium for every share. So for a standard 100-share contract, that's $300 in your pocket instantly. Now, you just wait. As long as stock ABC is trading above $95 when that contract expires, the option is worthless, and that $300 is pure profit.
So, when the dust settles, one of two things is going to happen. The best case, like we just said, the stock behaves, it stays above the strike price, and you pocket the premium. Easy. The worst case is the stock takes a nosedive. If it falls to, say, $85, you are still obligated to buy it at your strike price of $95. The good news, if you can call it that, is that the premium you collected up front helps soften that blow just a little bit. All right, so that's what you do when you're bullish. But what if you think a stock is headed for a downturn? What if you're bearish? Well, that's where the other side of this coin comes in. Selling call options. A call option is pretty much the exact opposite of a put. When you sell a call, you're making a promise to sell shares of a stock at a specific strike price. But this time, your obligation kicks in only if the stock's market price rises above that level. And just like before, you get paid a premium up front for taking on that promise. Let's run through another scenario. You're looking at stock XYZ, and you think, nah, this thing is overvalued. It's definitely going to stay below $70. So you sell a call option with a $70 strike price, and bam! You instantly collect a premium of $6.20 per share. If you're right, and the stock never gets up to $70 before the option expires, that contract becomes worthless. And that $6.20 per share, it's all yours to keep. So again, we have two very different outcomes. Best case, you were right. The stock stayed flat or went down, and you just walk away with the premium. But, and this is a huge but, the worst case scenario here is where things can get really, really scary. If you're wrong, and that stock doesn't just go up, it skyrockets. Well, now you're forced to sell shares at $70 that might be trading for $80, $90, or even more. And this introduces a massive risk we have to talk about. You know, this point is so critical, it's worth highlighting directly. Think about this. Your potential profit is limited. It's capped at whatever premium you collected. But your potential loss isn't limited at all. A stock's price can, in theory, just keep going up forever. Selling a call option without owning the stock, what's known as a naked call, can be an absolute disaster. Which brings us to probably the single most important concept you need to know before even thinking about this stuff: the difference between selling naked versus covered. Getting this difference is absolutely non-negotiable. The names sound a little weird, but it's actually super simple. Naked writing is when you sell that option contract without actually owning the shares of the stock. You're exposed. Covered writing, on the other hand, is when you sell a call option on a stock that you already have sitting in your portfolio. You're covered. And the difference in risk between these two is night and day. It is everything. The naked call seller is completely exposed. If the stock goes to the moon, they have to go out into the open market, buy those shares at the new, insanely high price, just to turn around and sell them for a massive loss at the lower strike price. But the covered call seller, they already own the shares. If the stock takes off and they get the call to sell, they just say, okay, here you go, and deliver the shares they were already holding. The risk is massively reduced.
And that is exactly why writing covered calls is one of the most popular option strategies out there, period. It's a relatively conservative way to generate a little extra income from stocks you're planning to hold for the long term anyway. It can basically turn a stock that's just sitting there, not doing much, into an asset that's paying you regularly.
Whew. Okay. That was a lot of information. So let's just take a second here and boil it all down to the most important things you need to remember from all this. All right, here's the cheat sheet, the stuff you absolutely have to remember. Number 1, you sell puts when you're bullish. You sell calls when you're bearish. Got it? Cool. Number 2, selling naked options is playing with fire, especially naked calls where your risk is theoretically infinite. Number 3, covered calls are the safer way to play because you use stock you already own as your safety net. And finally, and this is huge, always have an exit strategy before you enter a trade. Know how you're getting out.
And that really brings us to the final question. Now that you get the why, the counterintuitive logic behind selling options, the real question for you becomes a practical one. Where could a strategy like this, selling covered calls for income, or maybe selling puts to try and buy a stock you love at a discount, where could that fit inside your own diversified portfolio?